Jeffrey Kane of DealBook. I'm with my colleague, Andrew Ross Sorkin, and we're here today to talk about a deal that has tongues wagging all along Wall Street, in Silicon Valley, and in Washington. It's Goldman Sachs' $450 million investment in Facebook. And Andrew, you and Suzanne Craig reported something very interesting today. Can you tell us a little bit of what that was about?
Well, there's a new caveat to this story, which is that prior to Goldman Sachs making this $450 million investment on their own balance sheet, they actually offered the opportunity to one of their most influential and powerful investment funds within Goldman Sachs on behalf of their pension clients and sovereign wealth clients, partners at Goldman Sachs. It's called Goldman Sachs Capital Partners. And that fund actually passed on the opportunity to buy in to the Facebook offering.
And why did they pass?
Well, it's interesting. There's two issues. One was the valuation. Lots of questions about this $50 billion valuation. Is it too high? The other issue is that ultimately this particular fund likes to take long-term investments and big stakes. Having said that, at least according to one of our sources, had they thought this was an easy home run, they said, they would have changed their philosophy and taken the deal. But what's important about this is it's raising questions among some of Goldman's most savviest clients who are looking at this deal saying, well, if Goldman Sachs Capital Partners, one of the best funds that Goldman Sachs has, decided against pursuing this, should we be making the same bet?
Right, and Goldman, in fact, is now pitching those wealthy clients to invest in a special fund that will invest in Facebook.
Right.
What are they being told, these investors?
Well, they're being told that there's a special purpose vehicle. It's at $1.5 billion. Only 499 investors can invest. At the moment, it's oversubscribed, so it's unclear whether this news is making an impact. But the idea is that this is a once-in-a-lifetime opportunity because you're going to get in on the ground floor before an IPO. Of course, you have to then cross your fingers and hope that this company, if and when it ever comes public, would be worth more than $50 billion.
Now, the $450 million investment by Goldman is being carried on its balance sheet. Some people have wondered, how can this be? Wasn't Dodd-Frank meant to prohibit speculative investments like that? How should we think about this?
I think that's a very important question, and unfortunately, I don't think we have a clear answer. Dodd-Frank and the Volcker Rule were supposed to, at some level, guard against something like this. Though this is a long-term investment, it isn't a short-term trade. You could argue it's a strategic investment for Goldman Sachs in that it will provide them with an opportunity and a calling card to sell this investment to their investors, a potential opportunity at maybe leading an IPO down the road. So it's an investment, A, that's been hedged, and B, that may be strategically beneficial to the firm.
Right. So in that sense, it's been a very familiar pattern for Goldman Sachs, right? It took Ford Motor public, eBay.
Right.
Can you talk a little bit about that?
It's done this repeatedly. This is part of Goldman Sachs' playbook. They probably do it better than anybody else on Wall Street. They take pieces of firms, they get in there, they create these relationships. They're then able to extract all sorts of other fees. Facebook employees will likely become Goldman Sachs clients as a result of this. So it's a virtuous circle or a vicious cycle, depending on how you look at it.
Thank you, Andrew. I'm Jeffrey Kane for DealBook.